Welcome to the Daily Market Recap. Today is Thursday, June 25th, 2026. Talk about a chaotic, head-scratching day on Wall Street. The stock market meandered to a completely mixed finish today as a massive tug-of-war broke out between charging bulls and defensive bears. The main culprit, a high-stakes drama in the tech world. On one side, artificial intelligence stocks veered right back up their crazy roller coaster ride, ignited by an explosive corporate report. But on the other side, a tech titan dragged down the major averages after dropping a pricing bombshell on consumers. By the final bell, the S&P 500 finished virtually flat, slipping less than 0.1% after swinging wildly between green and red all morning. The tech-heavy Nasdaq shed 0.5%, while the blue-chip Dow Jones managed to eke out a modest 71-point gain. It was the definition of a choppy, directionless market struggling to find its footing. Under the hood, the sector action tells an even wilder story. Technology was a tale of two completely different worlds. Semiconductor and memory chip makers were absolutely on fire, throwing a massive green party. However, mega-cap tech heavyweights face intense pressure with massive selling in select giants, completely offsetting the broader market's strength. Because of this mega-tech drag, we witnessed some serious defensive rotation. Investors pulled cash out of stretched tech valuations and dumped it straight into small-cap stocks. This helped the small-cap index completely outperform its larger siblings today, showing that market breadth is alive and well, even when the big tech generals are bleeding out. If you want to know how everyday investors are actually feeling through all this turbulence, look no further than the Fear and Greed Index. Today, the index is sitting at a chilly 25, which firmly places us in extreme fear territory. That is down significantly from neutral levels just a couple of weeks ago. Traders are visibly spooked by stretched valuations, recent tech pullbacks, and the threat of macro updates. The vibes on the trading floor are incredibly tense right now, with everyone tiptoeing around waiting for the next major catalyst to drop. Our absolute blockbuster story of the day belongs to Micron Technology. The computer memory powerhouse blasted off, jumping a spectacular 15.7% by the close. Micron completely shattered Wall Street expectations, reporting massive profit and revenue beats for the latest quarter. Even better, their forward growth forecast for the current quarter was an absolute monster. This stunning report single-handedly revived the entire AI memory trade, calming nervous investors who feared the sector had grown way too expensive after an absolute parabolic run this year. The message from Micron was crystal clear. The deluge of dollars pouring into artificial intelligence data centers is not slowing down anytime soon. But here's the twist. All that insatiable demand for AI memory means chip producers can charge top dollar and someone has to pay the bill. Enter Apple. In a shocking move, Apple announced it is hiking prices on many of its premium products, including a massive 15% to 20% price increase for Mac computers, according to analysts. Wall Street did not take the news well. Investors are terrified that these steep price hikes will severely crush consumer demand in an already sensitive economic environment. As a result, Apple shares tumbled 4.5% today, acting as the absolute heaviest anchor dragging down the S&P 500 in tech sectors. Rounding out our top three stories, we got some highly anticipated macro data that gave the bond market a breath of fresh air. A key consumer inflation report revealed that while consumer inflation accelerated to 4.1% last month, up from 3.8% previously, it matched economists' expectations perfectly. Traders let out a massive sigh of relief because it wasn't worse. With a recent drop-off in international oil prices helping cool future expectations, benchmark Treasury yields plunged across the board, with the 10-year yield slipping down to 4.39%. Less pressure from bonds is a huge win for equities, giving the broader market some much-needed breathing room. All right, team, it is time for everyone's favorite part of the day, the scoreboard. Let's break down the hypergrowth standouts and the absolute train wrecks that move the needle today. We're looking at double-digit explosions, meme stock revivals, and severe post-earnings hangovers. Let's see who won big and who got completely crushed. Leading the charge into the green zone, our top gainers today were Tech, SNDK, BBMU. Leading the pack was Micron, ticker MU, with that spectacular 15.7% surge on earnings that we just talked about. Right behind it was SNDK, riding the massive coattails of the chip sector's structural memory revival. Meanwhile, the retail meme stock playbook made a wild comeback as BB experienced a massive short squeeze surge, proving that individual retail traders still love to throw a wrench into Wall Street's plans. Finally, biotech innovator Tech caught a massive wave of buying volume after a positive regulatory update. Talk about an incredible day to hold these names. Now, for the painful side of the ledger, our top losers today were TCOM, FIG, MSTR, Duol. Suffering the worst of the tech sector rotation was MicroStrategy, ticker MSTR, which got hammered as highly leveraged tech proxies were aggressively liquidated. Duolingo, ticker Duol, also took a massive hit, dropping sharply as algorithmic growth concerns spooked momentum buyers.
Travel giant TCOM faced heavy selling pressure amid broader global growth concerns, and financial play FIG rounded out the losers as defensive asset rebalancing forced capital out of financial services. If you own these today, pass the ice because that's got a sting.
Let's map out the battlefield lines using the major ETF trackers, starting with SPY, which tracks the S&P 500. After today's choppy action, SPY closed right around the 7,357 level, continuing its tense consolidation. For the bulls to regain full control, they need to reclaim and break above immediate resistance at 7,400, with a major secondary ceiling sitting at 7,440. On the flip side, if the sellers push back, keep your eyes glued to the critical support zone at 7,300. If that breaks, a deeper pullback toward key structural support at 7,276 is highly likely. Next up is the tech-heavy QQQ tracking the NASDAQ. Thanks to the heavy drag from Apple and Microsoft, QQQ closed down at 25,358. The chart shows a very clear technical crossroads here. Immediate overhead resistance is resting at 25,600, and the bulls will need a massive tech rally to break past the stronger psychological resistance at 25,800. For support, the 25,200 line is the absolute immediate line in the sand. If the tech sell-off accelerates and drops below 25,200, expect a fast slide down to the major psychological support level at 25,000 flat. Finally, let's look at IWM, tracking the small caps of the Russell 2000, which was today's absolute star performer. Thanks to that beautiful rotation out of megacap tech, IWM surged to close at 3,007.86, triumphantly breaking above the major 3,000 psychological level. For the momentum to stay alive, IWM needs to establish 3,000 as rock-solid new support, with secondary support sitting lower at 2,980. If the bulls keep running, the next major resistance targets are locked in at 3,050. Watch this ticker closely. It is currently leading market breadth. Switching gears over to the digital asset space, Bitcoin is putting on an absolute nail-biter performance. BTC recently dipped just below the major $60,000 psychological level, executing a tense mid-year consolidation. We are currently watching a range-bound structural digestion phase after a multi-week slide. Right now, Bitcoin is hovering right around $59,500. Key support is glaringly obvious at the $59,000 mark, with a secondary macro support zone resting at $58,000. If the bulls want to spark a real reversal, they absolutely must reclaim and break above overhead resistance at $62,000, followed by a secondary target at $63,000. Ethereum is following the exact same consolidation blueprint as its older brother. ETH has been caught in a tight range-bound pattern. Trading defensively as macro uncertainty and reduced directional momentum keep the market relatively calm. Leverage across the derivatives market has significantly dropped, which is actually healthy because it reduces the risk of sudden painful liquidation cascades. For Ethereum, the immediate line in the sand for support is sitting at 3,300. To turn the tides back into a full bullish frenzy, buyers need to push ETH back above key resistance at $3,500 and hold it. As for the broader altcoin market, it is currently in a state of quiet stabilization. Total open interest across crypto derivatives has quieted down to around $20.6 billion, showing that the high leverage degeneracy has left the building for now. While selected speculative tokens are making isolated noise, the vast majority of altcoins are moving entirely sideways. Carefully digesting recent pullbacks and waiting to see if Bitcoin can firmly establish a bottom above its current support zones before making their next big explosive move. As we wrap things up, the overall market sentiment heading into tomorrow can be summed up in two words: cautious consolidation. With the fear and greed index flashing extreme fear at 25, the market is playing intense defense. However, the strong rotation into small caps and easing bond yields prove that buyers are still hunting for value beneath the surface. We aren't in a free fall, we are simply in a high-stakes waiting game.
So what is the absolute #1 thing you need to watch tomorrow morning?
It is the official release of the core PCE inflation report, the Federal Reserve's absolute favorite inflation metric. This data release is going to be a massive market mover. If the numbers come in cooler than expected, it could ignite an explosive relief rally across tech and crypto. But if it flashes hot, get ready for another bumpy ride. Buckle up, watch your risk, and I will see you right here for the next breakdown.